Well, let's start with Chevron, which was clubbed like a baby seal today on oil weakness. I say that's good, not because I like seal killers, I don't, but because Chevron stock got cheaper as it goes down. I'm a big believer in the oil stocks for 2023, although they're not going to be as great as last year. Going forward, you have to be selective with the oils because when the Fed slams the brakes on the economy, that tends to put downward pressure on energy prices. But as long as oil stays above 60, and I think it will, I think Chevron has a good chance despite today's trading. As I said at the top, it's okay to go against the grain, especially if China reopens and Russia may be forced to be a little more rational at some point next year.
Altria just launched IQOS in the U.S. for the first time. Their first market is Atlanta. So in Atlanta, they opened a store in an upscale mall, Lenox Square. There you can buy the device. You can also buy the heat sticks, which are basically the little tobacco sticks that go inside the device. Interestingly, you have to be 21 years old in order to enter the store. They check your ID when you enter, and they ask you if you're a current smoker. And they say that if you're not a smoker, then you will not be allowed in.
Your Best Buy is up over 5%.
Well, I told you. When you have a stock, we have to start talking about these stocks.
By the way, I don't have the PE below 8. I got it around 12.5. So,
well, I mean,
on this fiscal year. So I'm not sure what numbers you're looking at.
Well, I'm just saying that going into this, if you thought that the stock was going to be down big, it would be on my list.
Okay.
I think that I want to make these cases. Carl, here's what we never talk about anymore because everyone's so down. Let's say you have a CEO who is great as Corey Bird. She told me that gaming was going to run its course, okay? She told me that they've got enough PCs to be able to handle work from home, but not more. She told me that they had a system called the Total Tech membership. Now, it did hurt their numbers. That would make it so basically you could have, for home office, you get IT. I think it's fantastic. You get IT. You know, remember, home office, the IT person doesn't want to come to your house, but the Best Buy IT person comes. And they're respectable and terrific.
How to get huge dividends in 2024 from 5 top Wall Street stock picks. What's up, everyone? Welcome back to the InvestMinder YouTube channel. Thanks for joining me today as I reveal 5 of Wall Street's top stock picks for 2024 that also pay gigantic dividends. Stay tuned as I give you all the details on these 5 dividend stocks so you can get those juicy dividends and potentially big returns in 2024. Before we dive in, please take a moment to like this video and subscribe to the InvestMinder channel to get updates whenever I post a new investing video. Your support really helps the channel keep growing. Now, just a quick disclaimer that I'm not a licensed financial advisor, and this video is just for entertainment and information purposes. Please do your own research before investing. Alright, with that out of the way, let's get to those 5 big dividend stock picks.
Number 5.
Realty Income, the monthly dividend company. As a triple net retail REIT, Realty Income owns over 13,250 commercial properties across the U.S. and international markets. Major tenants include convenience stores like 7-Eleven, pharmacy chains like Walgreens, dollar stores, fitness centers, restaurants, and auto service businesses, amongst hundreds of other retail, industrial, and service industry tenants. What makes Realty Income special is the focus on only acquiring high-quality real estate leased to industry-leading tenants on very long-term lease agreements. We're talking 10, 15, or even 20-year initial lease terms here. Not only does this create an extremely reliable stream of rental income spanning decades, but it also leads to high occupancy rates consistently above 96 to 98%. In good economies or bad, those rent checks from Walgreens, 7-Eleven, and other large, service-oriented businesses keep pouring in. This resilience allowed Realty Income to keep revenues and funds from operations growing straight through the great financial crisis in 2008 to 2009 without a single blip. And that reliable rising income flows right through to investors via Realty Income's trademark monthly dividends. Dubbed the Monthly Dividend Company, Realty Income has made dividend payments every single month for over 50 years since going public in 1994. Even more impressive is that Realty Income has increased its dividend 122 times over that stretch, including for the past 98 consecutive quarters. This gives the stock a place on the prestigious Dividend Aristocrats list as one of just a handful of companies raising payouts for 25-plus straight years. Between the 6,100% total return Realty Income has generated since listing on the NYSE in 1994, and over 600 cumulative dividend payments made to shareholders, this is the epitome of a buy-and-hold compounding machine. Looking ahead, Realty Income expects to continue putting up 4 to 5% annual FFO per share growth to support 5 to 6% yearly dividend hikes. Add a solid nearly 6% starting dividend yield to that, and total returns should continue compounding at a low, double-digit, annualized pace. It's no surprise then that Realty Income is a favorite among income investors everywhere who love getting that completely predictable monthly rent check from their shares. With Jefferies slapping a $66 price target on the shares along with a buy rating, total upside could approach 20%, adding price appreciation to the table too.
Number 4.
Chevron, which offers investors a generous 4% dividend yield from a diversified business model and 75-plus years of payout history. As one of the biggest publicly traded oil companies, Chevron has operations spread across almost every aspect of the energy industry value chain. This includes exploration and production of oil and gas, pipeline transportation networks, refining and marketing of refined products, production of lubricants and petrochemicals, and both renewable and traditional fuel offerings at over 8,000 Chevron and Texaco branded gas stations. This fully diversified business provides some insulation from volatility in any one area of energy. So while low oil prices may impact Chevron's drilling operations, the refining arm can pick up the slack, refining that cheap crude into profitable gasoline and other fuels. The scale Chevron operates is also just massive, with daily oil and gas production over 3 million equivalent barrels per day, ranking among industry leaders like Exxon and Shell. And through a recently announced acquisition of Hess Corp for $53 billion, Chevron is set to expand drilling capabilities further in key production regions like the Permian Basin. For dividend investors, Chevron checks all the boxes as an energy sector leader with staying power thanks to its diversification, scale, and balance sheet, carrying a strong A-rated credit rating even after the Hess deal funding. The proof lies in the dividend track record. Chevron has paid investors every single quarter, stretching back over 75 consecutive years. That includes maintaining and even growing its payout throughout multiple oil crashes and recessions when rivals cut their dividends to preserve cash. So investors can feel extremely confident collecting Chevron's 4% yield, knowing the company takes its capital returns seriously come hell or high water within the volatile energy space. Looking ahead, Chevron expects to leverage its increased drilling capabilities post-Hess acquisition to fuel strong production and cash flow growth for years. That should easily support modest dividend growth in the years ahead, just as it has for the past 35 straight years running. Between asset diversification, scale, balance sheet strength, and commitment to dividends through thick and thin, Chevron checks all the right boxes for investors wanting exposure to energy, along with a reliable and growing income stream.
Number 3.
Coming in at number 3 on our top dividend stocks for 2024 list is Hudson Pacific Properties, a fast-growing REIT specializing in office space catering towards media and technology tenants in areas like Los Angeles, Silicon Valley, Seattle, and Vancouver. As content creation and digital media boomed over the past decade with streaming giants like Netflix and Amazon Prime Video driving demand, the need for premium production studio space and post-production offices exploded higher. Major entertainment firms, both old school like Disney and Viacom CBS, along with new media players, have been fighting tooth and nail for limited studio capacity in media hotspots. Hudson Pacific seized on this by strategically acquiring and developing over 20 million square feet of prime Class A media office and studio space in the most sought-after West Coast media markets. Today, Hudson Pacific's portfolio consists mainly of trophy assets housing tenants from Hollywood studios to creative agencies and streaming platforms like Netflix and Riot Games. Media and entertainment names provide over 60% of Hudson Pacific's rental income, with technology making up another 25% through tenants like Google, Twitter, and Uber. This positions Hudson Pacific almost like a picks and shovels play, providing the real estate and infrastructure needed to power the ongoing digital media revolution. These attractive property fundamentals, combined with long lease terms averaging 7 years, support excellent revenue visibility and cash flow stability. That enabled Hudson Pacific to keep sailed through the pandemic disruption without a hitch while keeping its generous dividend intact. Speaking of that dividend, Hudson Pacific offers a sky-high 7.14% dividend yield that absolutely crushes the S&P 500 and REIT sector averages, hovering below 1% and 4% respectively. Despite headwinds from higher interest rates pressuring sentiment around REITs broadly, analysts still see significant upside ahead for Hudson Pacific thanks to secular tailwinds supporting strong demand for its media and tech-centric office properties. Jefferies in particular is pound the table on this hidden income gem with its buy rating and $120 price target, implying over 100% total return upside when combined with that 7% yield.
Number 2.
Our runner-up for number 2 income stock for 2024 is Altria Group, the tobacco giant behind legendary cigarette brands like Marlboro and Copenhagen, as well popular cigars like Black & Mild. While the U.S. cigarette market has steadily declined by low single digits annually for many years now, Altria has managed to tread water thanks large market share and continual price hikes that help revenues chug higher over time. Today, Altria's Marlboro commands nearly 40% of all cigarette sales domestically. Between its flagship smokable product segment still throwing off mountains of cash and alternative tobacco offerings like vaping, oral nicotine, and heated tobacco products picking up steam, Altria sees plenty of opportunity ahead despite societal shifts away from traditional smoking. And we haven't even touched yet on Altria's hidden ace card, its over 10% ownership stake behind global beer titan Anheuser-Busch. Altria's $1.7 billion position makes it the largest Budweiser stakeholder outside of controlling families. While Altria has long signaled intentions to maintain the legacy investment due to synergies like distribution overlap, some analysts speculate the company could look to monetize its stake to fund a big acquisition or capital return program. With bankers slapping a conservative $17 billion enterprise value on Altria's piece of Budweiser, the potential upside to unlocking this tucked-away asset is clearly massive. Any way you slice it, Altria is poised to keep its cash registers ringing thanks to strong leadership in lucrative nicotine markets and some intriguing embedded options like its Anheuser-Busch holding. And that sets the stage nicely for Altria's incredibly shareholder-friendly capital return profile, headlined by a sky-high 9.6% dividend yield. Not only does Altria pay out easily over half its profits via dividends, but the company has raised its payout every year for 52 consecutive years, making it an esteemed dividend king. Between an almost 10% starting yield, visible growth roadmap for its core tobacco business, and potential catalysts like a partial Anheuser-Busch stake sale, Altria checks all the boxes for income investors. Throw on top of that massive income stream one of the longest dividend growth streaks around, and it's no wonder why analysts at Jefferies slapped a buy rating on Altria with a $49 price target implying 20% total return upside.
Number 1.
Our number 1 dividend stock to buy in 2024 is none other than consumer electronics giant Best Buy. With over 1,100 big box stores and a thriving online business under banners like BestBuy.com and Buymobile, Best Buy is the undisputed leader in retail technology sales. Be it computers, mobile phones, gaming consoles, smart home automation, virtual reality gear, and pretty much anything electronic you can think of. Simply put, if it's powered by electricity and sold to consumers, chances are extremely high. Best Buy stocks it on their shelves and website. The company estimates over 95% of Americans live within 15 minutes of a Best Buy location, underscoring the chain's immense footprint and accessibility to shoppers locally and online. Now, while the rise of e-commerce and specifically Amazon has battered many brick-and-mortar retailers, Best Buy had not just survived but thrived thanks to savvy investments enhancing omni-channel capabilities. Almost half of Best Buy's nearly $50 billion in annual sales now originate online through avenues like website orders, in-store pickup and delivery, paired with consultative and specialized customer service online and in real life through its Geek Squad tech support fleet. Best Buy offers an end-to-end experience that Amazon simply cannot match. These competitive strengths have allowed Best Buy to successfully hold market share and even expand margins in pivotal growth areas like computing, mobile phones, smart home tech and home appliances, a trend expected to continue. With secular tailwinds supporting demand for consumer electronics showing no signs of slowing alongside increasing market dominance, analysts forecast strong mid-single-digit annual earnings growth ahead for Best Buy, likely to drive nice share price appreciation over time. Adding to bullish outlook, Best Buy also lays claim to a reputation as a true dividend overachiever, doling out a 4.9% yield, crushing the market average while also notching 20 consecutive years of payout hikes, putting it in rare dividend aristocrat territory. So for investors seeking a best-in-class retailer position, keep gaining market share in hot tech segments while producing substantial income, Best Buy simply can't be beat. It makes sense why Wall Street analysts have been tripping over themselves to sing Best Buy's praises, with Jefferies the latest to slap a buy rating on shares complete with an $89 price target, meaning total returns could eclipse 25% annually when combined with that nearly 5% dividend yield. The bottom line is this: if you're looking income and upside in 2024, pick one of these 5 top Wall Street stock picks and see the money flow in.
And there you have it, folks. The top 5 dividend stocks for 2024 paying huge yields handpicked by Wall Street analysts, along with the bull case and total return outlook for each pick. I hope you found today's video helpful, summarizing why Altria, Best Buy, Realty Income, Chevron, and Hudson Pacific made the cut as Jefferies' top income ideas for the coming year. Which of those 5 dividend stocks are you most excited about adding to your portfolio? Let me know in the comments section below. And if you enjoyed today's analysis, do me a favor by leaving this video a like and subscribing to the InvestMinder channel for more dividend investing videos like this. As always, a quick disclaimer that I'm not a licensed advisor, and this video is purely for entertainment purposes only and not investment recommendations. Please do your own research before buying any stocks featured here today. Alright friends, I hope you crush it with whichever dividend stocks you choose to invest in this year and enjoy that added income. Thanks so much for watching, and I look forward to seeing you in the next InvestMinder YouTube video. Happy dividend stock picking out there, and best of luck with all your trades.